Hey folks, welcome back to the channel. It's Liquid here. A couple of weeks ago, I put out a video warning against buying stocks in the market in the short term because when I was looking at the S&P 500, which is this chart here, it seems like 2022 has been in this downward channel, and every time this year the stock has gone up to the top of this channel, we have seen a sell-off in the stocks. So in late November, we were getting very close to the top again. So that's why I said, be cautious. If we take a look at the SPY, which is an ETF that you can buy that actually tracks the S&P 500, and looking at the weekly chart, it's almost like clockwork how every time the market comes up to the top of this channel, this red line here, it does a major bounce off of it. So that was the first time, and then another time over here. And then in July, we had another touch. And then finally, we have this time. This green candle here marked a couple weeks ago when I said, we're getting pretty close to that and just watch. We're either going to go through it and go higher, or it's going to get rejected just like the previous 3 times. And here's what happened after. The stock market the next week went up, touched the line, and then this following week it came in and it fell to 393. So basically a touch on the top yet again. That's the 4th time this year. So it looks like we're in this chopping pattern, a trend of lower weeks followed by higher weeks, and then down, up, down, up. Most likely we are going to head back down again. Very likely we're going to reach the middle of the channel, which is right here, this blue dotted line. So where do we go from here? Well, I'm going to move this blue line over to this next following week, which is over here. And most likely we're going to see this go lower. The only bullish case I can see is that we are still above this 21 EMA. So this upcoming week, SPY could end up higher, maybe in the 390 to 400 range, which would be this blue channel here. If that's the case, then we might get a retest of the top of this bear channel. However, if we break through this 21 EMA, then I think the week after, we're probably going to see a pretty substantial red candle. So right now I am still bearish just because we are really close to the top of this bear channel. And since we've been in this channel since the beginning of the year, it's just not very likely that now's the time that we break through it and go higher. Obviously that is a possibility, but the more likely outcome going into the next couple of weeks or even the next few weeks is a downward trend, just because we see this pattern playing out in the past. Over here, we had a green candle, and in the next 3 weeks, we're pretty much down. This doji here is green. That's because it went up during that week, but compared to the previous week, it still closed lower. And then in April, we had another green candle, followed by 3 red candles. In August, September, again, it's the same pattern, green candle, followed by 1, 2, 3 red candles. Once again, this most recent situation, we have a green candle followed by a red candle. So what do you think the next 2 candles are going to be? My guess is probably down, because even though we are still above this blue line here, in the past it didn't really matter. Here you can see the stock market was above the 21 EMA, and then after the first red candle, it was lower by quite a lot. Same thing over here. This green doji is kind of on the EMA, but the next 3 weeks down. This one as well, it started above the EMA, but that did not stop the stock market from dropping over the next few weeks to below the EMA. So I'm looking for lower price targets. If I take a look at the measured move previously of how much the SPY is likely to go down, we'll use the most recent one from the top of the channel. We'll count 1, 2, 3, 4 weeks. So the most recent one was like this kind of angle. And if we do a measured move here, then in a couple weeks time, let's say by the 23rd of December, which is 2 weeks away, we could be looking at somewhere around here, like 368, assuming the previous patterns we've seen this year continue. So in terms of what I'm doing with my portfolio, I'm thinking about buying put spreads, because if you are pretty confident about the direction of a market, you can use options to increase your gain potential without taking on too much risk. Because if you're buying options, the most you can lose is just what you paid. But if your price prediction is accurate, you could stand to make quite a lot of gains, more so than the stock market. So for example, if I believe that we're going to see a couple more red weeks coming up, and it is likely for the SPY to end the week on Friday the 23rd at around 268, let's just call it 270 to make it easier, then I could short the SPY right now. So I would sell it at 393 and try to buy it back at 370. Now, if I am correct and it goes to 370, assuming I just sold one SPY unit, then my profit would be 393 minus the 370. and that'll give me $23. And I spend 393, so that's about a 6% return. Now, even though I think it's likely that the stock market will go down, it's very unlikely that it'll hit exactly 370. And for the risks that I'm taking, it seems like a 6% profit is not really that worth it. So what I can do instead is sell a put option spread. Now, this is more risky in a way that I could potentially lose more money, but because I can control the range of the spread, I can simply choose to risk less of my capital. So here's what that might look like. This is the SPY option chain. Now, SPY pretty much trades every day. If I look at this upcoming Wednesday, which would be the 14th, the implied volatility is probably going to be very high for that day. So IV of 30, which is quite high for the SPY, and this is because the previous day on the 13th, we have CPI data coming out, so we'll get to see if inflation is continuing to go down and on track. This will be a big day. I expect the stock market to be very volatile. And then December 14th is probably the highest IV day of the next couple of weeks. And that's because we have FOMC with Jerome Powell giving us another interest rate hike, most likely 0.5%, but we'll have to see. And more likely than not, the stock market is going to react very aggressively. I don't know in which direction yet. It depends on the speech he gives that day. Now, because I'm not confident, like in short-term market fluctuations, I like to look at least a couple weeks out in this case. So that's why I'm choosing December 23rd, which is 2 weeks away, which is this Friday over here. So to buy a put spread, all you need to do is buy a put option. And let's say I'm going to buy one out of the money. So the current price of SPY is 393. So maybe I will buy a put at 390. So it's just below the current price. Now, if I buy this option, you can see it's going to cost me $614. So in order for me to make money by December 23rd in 2 weeks, SPY would have to be basically 390 minus 6.14. So it has to be below 384 roughly, which is over here. I'll make this blue. Okay, so basically by this dotted blue line, SPY has to end below this blue line for me to make money. Otherwise, I lose all of the $600, which doesn't seem like a very good idea, because if for some reason the stock market bounces off of this EMA and it heads higher next week, it could try to retest the top of this channel, right? And if that's the case, then I basically just lost like $614. So that's why I like to buy put spreads instead for something like this. So maybe I will sell. So I'm still going to buy the 390 put, but maybe I will go down to, let's say 385, and I'm going to sell this 385 put. And this basically gives me a bear put spread that I'm going to buy. If I want to reduce the amount of money I could lose, all I need to do is just tighten up that spread. So instead of 385, I will sell like the 388 or the 387. But right now, instead of paying 614, I'm going to pay the difference between the two, because even though I'm buying this put option at 390, I'm selling this at 385. So I'm going to get $422 from selling this put. So that's going to be, looks like about 186. So instead of risking $614, which could, easily just be gone if the stock ends above 390, which is certainly possible, I'm only going to lose $186. That's my maximum loss. But the reason I like the put spread is because if you think about the maximum gain you can get from this, let's say the stock goes to my target of 370. Well, 370 is below 385, which means I am going to make the difference between 390 and 385, which is a $5 difference. And because there's 100 shares in each contract, that's $500. So my maximum profit is $500 minus 186. Let's say it's 190 for if we add in commission. Let's say commission is going to be $4. Okay, so that's a profit of $310, and I only put up $190, so that's 163% return. So even if I'm wrong this time, but over the next 10 times, let's say I'm wrong half the time, well, I'm still going to be ahead this way, because if I'm wrong, then I lose 100%, but if I'm right, I make 163%. If my thesis turns out right, I make a lot more than if I just short the stock. So that's a good way of using options. Let's take a look at what the break-even point is. So looking at the profile here, my break-even is 388. So that's going to be right here. I'm going to move this line to 388 instead of 390. So that's my break even line, this red line right here. So that's one way that I'm looking at playing the next couple of weeks. I would not try to do this on individual stocks because that can be more uncertain than a market index. Another thing that a lot of people could do over the next week is just not do anything. Because next week is going to be a very volatile week. If I go to the daily chart here, get rid of these lines. So next Friday is the 16th, which will be over here. From now until the 16th, there's 5 trading days, but there's inflation data and an interest rate announcement. So we could go as high as basically 409. And depending on the economic data, we could go as low as, I mean, we could even go past 370 and go down into the 360s if the news is super bearish. So it's totally okay to just sit this next week out and not really do anything and just wait and see what happens after. Because from after this week till the end of the year, there's not going to be a whole lot of expected news coming out or economic data. So that might be a better time to go back to selling weekly or monthly options. Now, if I do plan to sell a put spread, then I would probably get out of my position if the stock moves above the top of this bear market channel. Right, so if it pokes out here, then I'd probably just close my put option and take a loss there. It won't be like $186 loss, it'll probably be like $150. That would definitely signal that the bullish trend is back in play. But otherwise, as long as it stays below this red line on its way down, I will continue to be at least short-term bearish on the markets. So that's it for me. Good luck with your investments out there. Remember that if you do buy any stocks during this really volatile time, what you're investing in right now will probably go down in the short term. So have a at least 2 to 3 year time horizon for those stocks. And if you're not sure, you can just stay out of the markets for now. And I don't mean like sell everything and get out of the markets. I mean like don't make any trades. If you have cash, just sit on cash. See what happens after a couple weeks. You can even wait until the new year to deploy new capital, because then that's when you'll have extra room in your TFSA or RSP, and you can contribute to those tax advantage vehicles and start investing new money in the new year, which I think a lot of people are going to do. And by then, it'll probably be like somewhere around here in January or February. And at that point, it's a much better price to get into the stock market than up here right now. No guarantees, of course, but that's just my prediction. So anyway, thanks a lot for watching. Good luck with your investments, and I'll talk to you in the next one.